Olga, welcome to the Beyond the Tools podcast.
Thank you. Thank you for having me. I'm super glad to be here.
So, for our listeners, of course, we met at the EPIC conference in Florida, and I just love that, we were at this networking event. Networking's at conferences always a little weird, and you just came up and you were like, "Hi, I'm Olga. I'm looking to meet people."
That's how you have to do it, right? I mean, how else are you going to meet people? You got to come up and introduce yourself to someone. So,
Yeah. No, it's true, and I just thought that was awesome. I liked you right away, so I was very excited that we got to reconnect and talk business a little bit more. And I think what we're going to get into today in terms of what you need to know about your financials in order to successfully sell your company. I know this is such a needed topic, so I'm really excited to dive in.
yep. And we will also cover a few things that are not financial, but that you need to sell your company well. Or let's start there. Can you even sell your company at all? Right?
Yes. Yeah.
And so the statistic on that out there is that out of all companies, not just HVAC companies, 80% of the companies that try to list themselves can't sell themselves. So they want to and they try to, but they can't. But for HVAC companies, because these businesses are recession proof, they generate good income, it's 52%. So I mean that's a stark difference, which is really great for HVAC business owners, but it's still half of the people that want to sell can't sell.
Yeah.
Um,
And that's shocking, especially
yeah,
because I know for a lot of our clients, that's the end game. If there's not somebody in the family to pass it down to, you're looking at, you want to eventually retire or you want to move on to the next thing. And being able to sell is so crucial, or at least having that option.
that's right. And statistically, it's, I think, about 33% of business owners pass their businesses down to their kids. And I think that's happening less and less
Yeah.
throughout the country and across different industries. Now, I do know that in HVAC, there are a lot of people whose kids are involved, but just because they're involved doesn't mean they want the business,
Yeah.
doesn't mean that they don't want to go and do something else later. And again, I think that 30% still really applies. So the rest of us, right? What are we supposed to be doing? And so a lot of people try to sell their companies to some sort of managers that are already in the company, and they've been with them for a long time. It's great. It's kind of in lieu of passing it down to the kids, but that is still a sale, right?
Right.
And you still need to know what's your company worth. You don't want to shortchange yourself, right? You're not here to give freebies to the next person, and this is money. This is so serious because this is money that you're most likely using to fund your retirement. This isn't just play money. This is living money. This is money to pass down to your kids, hopefully enough to pass down to maybe grandkids and make a difference in their lives,
Yeah.
right? So, how do we maximize that?
Yeah. Yeah, I think that's a great point because when we think about selling, a lot of times, you hear all this talk about private equity companies like swooping in and that sort of thing. So it's really interesting to hear, I guess, yeah, the different types of buyers and what's going on right now.
And so the different type of buyers, they're looking for different type of companies, right? So the smaller kind of individual buyers, they're really looking at smaller companies, probably under 2 million in revenue. And if you have a larger company and you're looking for a much bigger sale, right, and a much bigger number to be given to you at payout, you're probably looking at these either your competitors, like your larger competitors who are trying to expand into your market, and they're probably PE backed, right? They probably have some sort of investor backers, or you're getting bought out to be part of a portfolio, of some company, or of some investment group, right? And so these are sophisticated buyers. And so that's when it's now really important. It's always important to have your financials ready, for them to be consistent and for them to be reliable. Because really, what are any buyers, what are they looking for when they're looking at any business, right? Not just HVAC business. They want transparency and reliability so that they know what they're buying, right? You're telling them the story, but they don't know you, they don't know your business. How do they verify what you're telling them? Through your numbers, right? And so the numbers have to be reliable and consistent. Usually there's like a quality of earnings report that they ask for, so that a third party confirms for them, what are you making actually? And so like that's a term that everybody hears once they start this sales process. But what they also want as a second thing is ease of transfer, right? So how easy is it to take over your company once they buy it? Are they going to destroy what they bought by taking over, or because you leave?
Mm,
So it's like, how much risk is there?
yeah.
And so kind of to like bring this into, what do financials have to do with it? So a lot of the deals, one of the top issues of why deals fall apart when buyers start engaging with sellers is financials.
Right.
It's really surprising for people, for most people, because they kind of think like, well, why would financials, these are just numbers, right? Like, why would financials destroy my chance of selling my company when I have great marketing, I have great techs, my business is running well? Well, again, because, well, how is someone going to know your story?
Right.
It's your financials. Like, that is your story. That is your backup, right? For the story that you're telling out there about how great your business is.
Mm,
And so, what happens is, because most people don't really focus on their financials, and not only are they not using them internally to make better decisions, some people are just great at running intuitively their business. They intuitively know their numbers from
right.
just being in the business. Um, but you have to be able to show that to other people, right? And
Mm,
so once they start going through this process, they realize they can't answer in on paper with details all these questions that are coming in during financial due diligence from the buyers.
right.
Um,
So let's break that down a little bit. Like, what are some of the specific questions a contractor should be able to answer on paper?
yeah, yeah. Well, number one, you have to be prepared to provide 3 to 5 years of historical financials within a due diligence process. And so the longer you've been around, you're probably looking closer to the 5 years.
Right.
And so you need to be able to answer obviously basic questions of, what's your profitability, right? So how much money are you actually making every single month, every single year? What you should also know are things about your return on marketing spend. How does your marketing work? What's effective? What's not? How much does it cost you to acquire a new customer? How much does it cost you to retain a customer? What is your customer attrition, right? So churn, like how many customers are leaving if you don't do any marketing? How many customers are staying, right? So like, what is your retention rate for customers? Like, and how does it change like year over year, right? What's your kind of like lifetime span with a customer? And how many customers? So then it's your revenue breakdown. How much of your revenue is coming from installs? How much of it is coming from maintenance plans? How much of it is coming from repairs, right? And the more information you can provide about how you're monetizing your customers,
Hmm.
the better you look, right? Because you can answer the questions that they're thinking about. Because the buyers are looking to understand, how can I make more money? Not just how can I buy them and run the company as is. How can I make more money? They're looking for strategic opportunities, right? So something, maybe some sort of, maybe they have capability or access to markets or vendors that you don't have, and so they're kind of looking to see, what can they do here.
Mm,
And so the more information you can provide them with, so that they can make their analysis and their calculations for future profit, the more likely they are to buy you, right? As long as the numbers make sense for them, right?
yeah.
Um, Other things that are really important is operational efficiency, right? So they're looking at your techs, the quality of your techs, right? The training, the pipeline that you have for labor recruiting, right? Because that's the longevity of the business. So is there a system like with schools, that you have, or some sort of like um, contracts, like where you have this pipeline constantly of new trainees coming in, so that the business can continue scaling. So then, back to the financials, it's how much money are you making per truck?
Hmm.
Can you also maybe figure out how much money you're making per hour or per day of a tech? Um, And so those are, these are to do this, it requires time tracking, right? It requires allocation of the salaries or the pay that the techs are receiving. It's basically what's called job costing, right? When you're figuring out the profitability of every job. And so how much money is your van making? If you have two guys in a van, right? How much money are you making per day, per van? So these are the kinds of numbers that help a buyer understand how what it costs to scale, and to increase. So like every time they add a van, how much money are they adding? Um, Understanding also your market saturation, right? So obviously everyone's always wanting to buy, and they will pay more for companies that are in a growing market
Right.
because the opportunity's there.
Yeah. Okay. So that's obviously a lot to be able to put forth. I guess when it comes to what needs to be presented to those buyers, yeah, I guess like how does that process work and what does good information look
Mhm.
like?
Yeah. So at first, you're providing, usually if you're a larger company, you're working through a broker. And so the brokers will ask you for your financials, which are 3 to 5 years of financials. And, they're asking for like monthly P&L, monthly balance sheet. Um, and then, of course, you can also at the same time provide your breakout of revenues by department, right? So like the installs versus service versus maintenance. But then like the meat of the questions is going to come from a buyer who's interested and who gives you a letter of intent. You sign some NDAs, and they start asking, they like kind of on paper what's happening, and now they have a lot more questions. And
Yeah.
so they will start, they'll kind of give you an estimate of, okay, we think we want to buy you out like at maybe this range. Does this seem acceptable? If they're within your range, you say, okay, let's keep this process going. And then they kind of give you this barrage, especially if it's PE backed. They will give this humongous list. Like it's a humongous request list, both for legal, show us your contracts, show us your documents, right? Your labor agreements, like all this stuff. But then it's a huge, there's a whole section for financial due diligence.
Mm,
And they're going to want to, and there are kind of tranches of this, right? So there's the initial phase. They'll ask for some things. If they like what they're seeing and you can substantiate everything that you've shown them in the very beginning, right, with your basic financials, they're going to want to keep going, right? And they're going to want to substantiate literally every number you've given them at invoice level, at payroll level per payroll.
yeah.
Like you have to be able to substantiate your numbers. And so you can't just kind of say, okay, well, we have so many problems in our financials. We're just going to book some journal entries to fix things, high level, so that we can have high level, good financials. It's not going to pass due diligence.
Mm.
So you have to be ready at detail level. Like, yes, it's great to have high level financials. You have to be able to break it down and zero in on any line they ask for because they will ask for a lot of different lines.
So
Um,
when a client comes to you, I guess, what's the gap that you see between what the buyers want and what that company is prepared to give?
the gap is huge. Now, I will kind of disclaim this by saying that we mostly work with companies that are under $10 million in revenue. And so most of the companies in that range, kind of like 3 to 10 is where our sweet spot is. And most of them really have not spent a lot of time on accounting. Yes, they may have staff in-house, and maybe they have what people refer to as the CPA, which is really a tax person, who really is in charge of filing taxes once a year. But they're not really focused on using their financials to make business decisions. They're not looking at their financials every month. It's more of just something they put together for taxes and
Mm.
because they have to. And their accounting team is more focused on operations, making sure people get paid, making sure that customers are paying and that they're collecting the money and that like cash flow is working, and much less on how are reports, financial reports being used, and how can we enhance them, make sure they're correct, make sure that they're on an accrual basis, closer to GAAP than just cash basis. Because cash basis financials, which is where most people are, tell you nothing about the business really. They don't tell you about the timing of your revenues or seasonality. They don't line up expenses to revenues in a certain time period, and so you really can't, by looking at these financials, you can't really understand, well, how much do you make per month or even per year, because everything is mistimed. And so that's why it's really important to be on an accrual basis. So that's one of the first things that we do is we switch everybody who's not already on an accrual basis accounting. And this is getting a little jargony here, but we switch them from cash basis to accrual basis accounting, which means that we're recording revenues when they're earned, not when they're basically earned, not even just invoiced, because invoices can be late,
Right.
but it's not when cash comes in. It's when they're earned, right? When you
Mm.
should be sending out the invoice. And the same thing with expenses. Just because you aren't paying somebody for 3 months, and you're delaying payment to a vendor, for example, it doesn't mean that the expense should not be recorded.
Right.
And so that's really accrual basis. And then there's, for most companies, there really is a big cleanup job going back, because again, you have to provide, it kind of depends on how far away are we from their sales target. If they're looking to start selling within a year, then we need to go back now and clean up the last 3 to 5 years, depending on how long they've been around. And that is a big job because, most of the time, there are a lot of bad entries. Their revenues could be wrong. They're definitely wrong within each period. And so these things need to get readjusted. The entries need to get fixed. And then, of course, on the expense side, we need to move expenses into the proper periods. So sometimes like your payroll doesn't come out on the 31st, it comes out on the 2nd. And all of a sudden you have three payrolls in 1 month, one payroll in the other month. Like this has to get fixed because then we need to be able to provide monthly profit and loss statements that are consistent
Right.
and show consistent profits. And this actually brings me to another point. So most people aren't really focused on their, at this level. I mean, they're starting to, the closer they get to 10 million, but they're not really focused on their profits. And so the industry standard, like where you want to be, is 20%, but a lot of the companies are 3 to 5%.
Mm.
So it's not that it's hard to sell a company that's at 5% profitability, but you're going to get so much less money,
Yeah.
right? Because the buyer knows that they can cut a lot of the fat that you didn't, right, and streamline your operations. But it's going to take maybe a year. It may take some tech investment, right? They may have to replace some of the people, maybe pay more in salaries, and of course they're going to more than make up for it, right? After buying your business and making these changes, but they're going to make you pay for it
Yeah.
because they're going to just take it out of your price because the risk is so high, right? And the effort that has to come from them is so high. And because you're going to have less interest. So they're going to have less competition, right? Because now you're looking for a buyer that's very hands on, and that knows what they're doing and can fix the efficiency of a company. And so, and is willing to kind of like invest in that. So your best bet is to fix your financials, analyze them. So let's say that takes 6 months, right? And so like thinking about timelines. And then you want to start using it to make decisions about, okay, where can you do some cost cutting? Or maybe where can you invest better in marketing to drive revenue growth? That's easy to drive, kind of like low hanging fruit, right? So how can we increase the profit that you're keeping? So maybe you're making these changes over a year, and that's being pretty aggressive, right? And so like you're zoned in, you're making these changes. So over the year, your profit margin is increasing. That's great. By the end of the year, let's say it's in a good spot. So now you want, maybe another 6 months to show that it's consistent and that you have consistently managed to maybe increase your profit margin to say 12%, 15%. Now you want to go to a broker, you want to start listing because now you have, you're showing 3 to 5 years and the prior years are not great, but now you're showing them a completely different company. You have a little bit of history to
Mm.
support. And then the regular kind of, the timeline for selling, brokers always say that it's basically 6 to 8 months to sell. And so with all this, we're basically at like 2.5 to 3 years before you actually sell.
Right.
So that's what, and that's why, again, you start talking to brokers and they're like, you really need to start thinking about selling 3 years in advance. That's like the normal number that's thrown out there. This is why, because it takes time. Your best bet is to start making changes, um, not only with your financials to make yourself more sellable and to be able to support your story during the sale, but it's because you also need to be making changes in your business to just get more money.
Yeah.
Um, because you deserve more money. Like you deserve, like you've been working so hard, right? And your whole family, like usually your wife's involved, because I mean, not to be sexist here, right? But 98% of people in HVAC are men, right?
Yes.
So speaking to the averages, it's a company led by a man, but his wife is very often in the business,
Yeah.
even if the kids are not. So this is a family endeavor, right? And you guys have been working so hard for decades. Uh, Accounting should not be the reason that your retirement dreams do not come true. Like 100%.
Preach.
Yeah. And I wanted to also mention just kind of the other things that buyers are looking for,
Yeah.
aside from consistent profits. So they're really looking for low owner involvement. So when I hear some owners say, well, we can go on vacation for a month, and the company keeps running, and we don't even call. We don't
Yeah.
call in. We don't look at our emails. Everything's great. That is amazing. That is gold. Gold.
So that's
But
the ease of transfer thing that you talked about at the beginning.
yes, yes, it means that the value of the business will not be destroyed when that owner leaves.
Yeah.
That is the fact that someone can build a business. I mean, in any industry where they can leave for a month, that is a real business, right? That is something to buy, and every buyer knows that because that risk is now diminished for them. Um, and they're also looking for solid. So again, this means low owner involvement means there's a real business that's running by itself. So the other part of that is there are organizational tools, right? There's management there. There's management tools that are being used. You're tracking inventory. This whole system is there, right? They're not just buying a bunch of people and some customers. There's a company to buy. They're looking for, of course, low customer attrition, right? So it means that you know what you're doing, you have a good brand, you have great reviews, because a lot of, according to statistics, a lot of the customers out there, they won't even call a company that has less than 4 stars. And so I'm sure you know this. Um, and so, that recruiting pipeline. So that's really important, because we all know there's this labor shortage in this industry, and so having that pipeline really shows that, and a marketing funnel, a solid kind of, so it's both a solid way to bring in employees and a solid way to consistently bring in clients, and monetize them, right, in an efficient way with a good return. So that is what really drives up the value of your company. And I don't think we've actually talked about the multiples yet.
No, yeah, and I know that's what everyone's
That's right.
dying to know. So,
Yes. And so, so to preface this, most people are kind of like, well, what's the multiple on my revenue? But we can't, that's not how it's discussed, right? And so that's when these like accounting jargons come in, like EBITDA or like seller's discretionary earnings. Everyone's like, what is that? So let's call EBITDA, basically your net income, but it's before like depreciation. And so depreciation, amortization is being probably the biggest add back there. So just your net income, you add back depreciation. Again, this is just for ease of like explaining it right here
yes.
without a graph and tables behind me. And so you're looking at this number. The reason why we're looking at this number and not revenue is because if you have an $8 million revenue company, if you're at 20% profit, you're keeping 1.6 million, right? And so that's what the buyer is going to keep if they just keep running your company as is every single year. If you are at 5%, which is where a lot of companies are, your profit is 400,000. That's a lot less,
Yeah,
right?
significant.
So, and it's going to take them so much longer to get the payback. And so that's why, we don't, and this is at the same revenue level. So it just has to do with how efficient your company and how profitable it is. And so that's why nobody gives multiples on revenue, because that's not what you keep at the end of the day.
Right.
And so we're giving multiples on the actual bottom line. And that's why the more changes you make, the more you increase that bottom line, the more you're going to get. And so when you're a small company under 500,000 in EBITDA, right, which is again that net profit adding back depreciation, which is where a lot of companies are, I would say under 5 million, again, with these lower profit margins, your multiple is going to be 3 to 4, right? So take that number, multiply 3 to 4. Again, a lot of these other factors of what they're looking for kind of determine the real number. And they will always be looking to get the number down, right? They're not here to fund your retirement. They're here to fund their profits
Yeah.
and their own retirement. So you don't want to give them reasons to cut your price. They will find all the reasons on their own. So the multiple is like 3 to 4. And so the way we're thinking about it, right, is it's going to take them 3 to 4 years to get paid back. And they want that payback much sooner because you have a smaller company, it's riskier. There's probably, not as great support, not things aren't well built out, right? It's going to be a much bigger investment for them to sustain this company and grow it. When you have a much larger operation, or your profitability is just much higher, and you're in like the 1.5 to like $2 million EBITDA number, your multiple is going to be 8 to 9. It is huge. And so they're basically willing to have a much bigger payback horizon. They're saying, we're willing to invest in this company, buy it out, and get paid over 9 years to actually get our investment back. So either they're doing that because, this is a business that they're buying maybe for their family and they know that it's for a long time. They're in this for like ever, right? And so 9 years is nothing for their maybe 30-year time horizon of owning your business. But what it also could be is that they know that they can take what you're selling to them and just spin it, and use it with whatever other capabilities they have to drive a lot more profit, right?
Yeah. So is it often the case that are you finding clients are coming to you proactively, or is it that they tried to sell and didn't get what they wanted, or is it that sales are failing? They're part of that, 52%, and they realize that their financials, their accounting was the reason that they're in that position.
I have never targeted and people who have failed at selling, and so I haven't worked with anyone who's tried to sell and couldn't, because I think it's just about who I'm coming across, right? And so mostly I just network with HVAC owners, and so I'm kind of catching them as they're thinking about selling. And so as we start having conversations, they become interested in, okay, how do we prep ourselves? Because like in my opinion, even if you're never going to sell yourself, maybe you're passing your business on to your kids, you should always be ready to sell yourself.
Yeah.
And it's it's kind of like that Boy Scout motto, right? Like be prepared, right? Because you don't know, because preparation takes so long, or it's like being prepared for a zombie apocalypse, right? And like having some stuff stashed away for emergencies. It takes time to prepare, but you never know when you need it. You may never need it, right? But you want to be ready. So because there's health changes, right? A lot of the owners of HVAC companies are above 50 and even 55. So it could be somebody in the family, right? So like health is a big issue, and when issues in health strike, there's no time,
Yeah.
right? And that is the worst time, honestly, for you to take price cuts. on your business, right? Because that is when you need it most.
Yeah.
Or just family changes, like life changes. Maybe you thought you were going to give it to your kids, and then they surprise you and they move to Europe, right? And they don't want to be in HVAC. So there's just all kinds of things that happen. And so you want to be in a good place, right? And be ready for whatever happens.
Yeah. Yeah, absolutely. I'm curious, what are some of your favorite success stories, or like, yeah, a client that came to you, didn't really know what they were prepared for to be able to sell, and what happened there?
So we did have a client that actually came to us. So that's actually another way that we come across clients is when brokers send them to us or their attorneys send them to us, because they know that their client wants to go in for a sale, and they're kind of like, well, your financials are really not ready, so you need to go back, fix them and then come back to us because we can't sell you like this. And so we had a referral. Client came in, and basically they had used several accounting systems over the last couple of years, and so they had like three different files, three different really like systems, right, with three different company books. So 1 year here, 2 years here, 2 years in the current system, and we had to provide 5 years. That's what was requested because they've been around for 27 years, and what the worst part was, it wasn't just, you couldn't just take reports from all three and just put them next to each other, because they didn't roll one to the other. So how one ended is not how the next one started. That's really, really bad. Because now you have to basically try to figure out why, and so you're saying, and that was just one of the issues, right? So the point is, we couldn't even create a basic report, a basic P&L report. Just forget, is it right or wrong? We couldn't run it for 5 years. Like, so really the only one that I could really rely on is, and again, rely on, it's the one from the current system, because at least that's ongoing. And then we started comparing it to their CRM, where the bills are actually coming out from. And it wasn't integrated with their accounting system, with QuickBooks. And so we started to basically compare their revenues, in one system to QuickBooks. They were not matching up in any month, right? And so we had to literally redo, and because this is a tight timeline, because they already had an interested buyer. So they came to us as they were already starting due diligence. And so there was no time to fix their QuickBooks. We didn't have 6 months here or even like 3 months. So we had to make changes. So we literally composed their revenues by month going back, out of their CRM. And we basically put that revenue on top of all the expenses that we pulled from their systems after fixing the issues that happened, that were caused by going from one system to another. Then there was a lot of cleanup. They didn't have cost of goods sold. So that's another issue. So, for anyone listening to this and thinking, what's cost of goods sold, find out.
Call
So,
you immediately.
yeah, yeah. So cost of goods sold is really direct labor and direct costs that have to do with you providing your service, or installing products. And so what you have is, you use it to calculate gross profit, right? So you have your revenues, then it's minus these direct costs, and you get the gross profit, which is your profit before all the administrative spend. And so that's very important, because that's how you scale, right? It's how much you're kind of like gauging how much money you're making by adding tax, right? And like adding more revenue. That's kind of like your gross profit. What do you keep from that? And then your admin spend is what has to get paid by all of this, by this gross profit. And then you get to the net profit, right? And so we had to identify their COGS. We had to pull out their cost of goods sold from all of their expense lines. And so that meant, they had just one payroll line. And so we had to run all their detailed payroll reports, for example, identify who their techs are, and anyone else who is a direct cost, We had to identify all the equipment expenses, and really like everything else that's supposed to be in cost of goods sold. We pulled it out of the separate lines, and it was in Excel, but at detail level, we had created their cost of goods sold. Um, this is not the way we want to be doing it, right? We want to be doing it in QuickBooks and fixing it in QuickBooks, but there was just no time. So everything had to be done basically in Excel, and we created this version of their financials that was correct, and it worked. And because we had it backed up with all of these details, we were able to answer all of the questions that came our way from the PE and this was a PE buyout, and everything they asked for. Again, we didn't provide everything they asked for. They asked for a lot of things across many different kind of like spheres, right? Like legal and here that we couldn't provide because these things that we just don't track. And
Yeah.
they have very generic kind of lists that they ask of everyone, no matter what their size and industry. But so we provided a lot. And every time they tried to dig in and like test us, we were able to fully support what we had provided them earlier. There was no like wavering. There wasn't like, oh my God, we made mistakes. Sorry, like this was wrong. And so, once they caught like a technical mistake, like in a formula, but that's fine. With all the documents that were provided, that's fine. And they checked for that. But we were able to explain all the trends, and all the changes kind of like with what was going on in the business. And yeah, it worked out really well. And the owner got what he wanted, and he was extremely happy.
And that's what it's all about.
Yeah. Yep. And like again, we didn't, accounting doesn't make the sale, but it can break the sale.
Yeah.
And so it's kind of like we're not driving your number, but we're like the backstop. We're making sure that number doesn't go down, basically.
Yeah.
It's the effectiveness and the amazingness of your business that drives its value. We're just here to make sure no one takes it down because you can't prove it.
And it's giving the owner that confidence and peace
Yes.
of mind, and ultimately giving the buyer the confidence that this is the right move.
That's right. That's right. And it's, both, with PE companies, they know what they're buying. Like they can tell, even if they can see all kinds of issues in your financials, more or less, they're looking at your bank statements. They're adding up all your invoices. They're making sure that cash is coming in. They're kind of redoing your financials on their own, basically,
Yeah.
on the side, because they have a whole team on you with lots of analysts. But they're not going to tell you. They're not giving you freebies. They're not going to say, "Oh, okay, well, you don't know what you have, and you have all these mistakes, but that's okay." They're not going to say it's okay. They're going to point out all the discrepancies and tell you they can't rely on your financials, and this is such a high risk, and therefore, here's your haircut because we don't feel great about this. And you need to be able to fight back on that, right? And you do that by being sure of your numbers.
Yes. Well, Olga, I think this conversation is so crucial. I feel like anybody listening is definitely going to be way more prepared. And I know we've only just scratched the surface here. So for anyone listening that wants to connect with you and learn more, what's the best way for them to do that?
Just go to our website, and there are ways to contact us there. It's nextstageadvisoryllc.com. So my Calendly's on there, other information, other ways to contact us. So we're always here to help. I pick up the phone for free. So just give a call. We're here.
Perfect. And I'll pop that in the show notes as well if you guys want to check that out at beyondthetoolspodcast.com. Olga, thank you so much. This has been such a great conversation, and I really appreciate you being here.
Thank you for having me. I feel like it was more me talking than like a conversation. I kind of stole the show. I have so much information to share.
Not at all. And this is what people are here for. They want to hear from the experts, and I'm really glad that you had so much that you were willing to share.
Thank you so much.